wild. And I would just issue caution on it because a lot of people are going to lose a lot of money and the volatility on gold is very, very high. Last thing I'll do, because we got to bring in Chris Pulver here, and I'll throw over the stream for him for a little bit, and I'm going to go get some water. Look, the average true range on gold is absolutely broken, okay? The average true move, let's go 200 bars back, and let's just look at this style. And when I say broken, I'm not saying it has to stop. It could keep going. Look at the average true range. You're talking about moving $60 an ounce per day right now. We used to move 20. This thing is so volatile, and a lot of people are going to get hurt by it. So please be careful. Size down on gold if you're touching it. Wait for your setup. Don't let emotions get to you. A lot of people will make a lot of mistakes in this. Please don't be one of them. Please trade safe. Be careful out there. It is Fed day. Up next, we've got Chris Pulver. I'm going to play this quick break, and then Chris Pulver will be here to take over the stream. Stay tuned.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Well, I brought the gold chart up since Nick was just talking about it. And I mean, look, it's great if you're in it. It's frustrating if you're not. It's testing your patience and kind of making you feel like I just gotta buy some. Look, I'm gonna have a little history lesson here. I can't bring myself to do anything more than the participation I'm already in, which runs from buying gold back here, adding more gold over here, adding more gold over here, taking profit here. So long, long, long. In the big picture, it's like I did a pretty good job with the highs right there. Now, when this position was done, after multiple years of adding to gold, that is profit. Now, I added more on that correction we saw back in October that is now up to fresh all-time highs. That is a fraction of the position that I built the last 3+ years. Okay? Now, I'm going to take you back to 2009 and 2011 because on a daily time frame, this is the one thing that is helping me stay disciplined and patient for just some type of volatility ahead. I also think, and I'm curious if Nick comes back on and joins me during the little previewed FOMC, something smells off in the market. And that would be the fact that we have gold just soaring to all-time highs, silver soaring to all-time highs with tons of volatility on both those precious metals, platinum going crazy, the dollar's down to the worst start in 40 years, plus another 4-year low. And somehow the VIX is at like 16.9. Like we had a little run from sub 15 VIX to 21 all the way back down to 15, and we're back at 16 and change. It's like the market is so complacent with just poking these all-time highs at 7,000 today. So anyway, I just think in the next 30 to 60 to 90 days, the market's going to give us something to talk about. And it could be, the bubble type move and the capitulation type move that we think we're kind of getting on gold and silver right now. But this is my history lesson. Take this chunk right here. This is the bar count going back to 2009. And when gold was off to the races after a great financial crisis and after a bottom here around 675, 680 or so, we got back above the 200-day moving average, and this is the last time that we tested it back in around April 09. Okay, now since that point, I'm going to zoom in here to make sure I'm not off by much. So this 200-day moving average in red. Yep, so this would have been April of 09. All right, so April 09 to that run, this bar count above the 200-day moving average stretched to here is a capitulation type move. And you can see here that we go up and pull back. We go up, we pull back. We go up, we go sideways, pull back. We go up, we pull back. And then it went up, 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 up. This move, by the way, you see my bar count? It's up to 610 bars. Big volatility, tested the high, 620, and then straight down to the 200-day moving average at 630. Right now, we're at 590 bars. Okay? Now, I'm not saying that it's got to happen today, but I'm thinking that in the next, let's say, 30 to 40 bars, maybe 50 bars at most, I would think that this market's going to have some type of snap type move. Now, that doesn't mean that we can't go higher, because this top here around 610 bars from the 200-day moving average, when this was all happening, this market stretched about 21% away. And this is what has caught my attention for now. Somebody guess how far away we are. Do you think we're further stretched away or less stretched away from today? So I'll say that again. We capitulated here back in 2011, got up to about a 21% move above the 200-day moving average, and then we smashed back below it. That set up a multi-year top, by the way. Okay, could it be different this time? Sure, it could be. But this is why I am thinking that there has to be some volatility ahead. And this is what is keeping me on the sidelines from adding aggressively at these crazy all-time highs. I will add more to my gold, okay? But even a test of any moving average is where I want to add to it. Even the longer-term trend out here is where I want to add to it. It is hard to justify from being like a, patient trader, disciplined trader. It is hard to justify why you would buy right here, other than you just have to. If you want to scalp this little bit with tiny little stop loss, that's fine. You can scalp with a plan. You can trade gold, but you got to have a stop loss plan, right? If you're trying to invest in gold, I can't be happy about a position here at 5,300. Okay, I mean 53 maybe does what? Goes to 5,600, maybe goes to 6,000, and then falls all the way back down to 4,000. So we are above 20+%. Here's my 200-day moving average. Here is my current price of gold at all-time highs again today. And we are 27% overstretched. Even back with a great financial crisis, it was 21+%. Now it's 27%. So, I think that nowadays the market is just like bigger, faster, stronger. And the market is clearly building a very strong kind of one-sided narrative that, is this the debasement trade? Is this the sell America trade? Is this the distrust in the U.S. system, the fiat system? Like, all these things are kind of being vocalized here. And obviously people are prognosticating on all these things to make it seem like this is the death of the dollar. This is the death of America, blah, blah. It's the same crap that's been going on for 2 decades. If anybody's ever heard of Stansberry and Associates, it's a newsletter for death of the dollar and death of America for 2 decades. Has any of that happened? No. So it's just a trade, but I want to add more gold. It's just, I can't do it here. So if we are on the verge of this being like nearer to the top than not, I can't buy these highs. Okay. So gold and silver making a great run. Silver, by the way, after a massive shooting star on this daily time frame, we're getting 2 days trying to test again. What would be kind of reassuring about silver would be if we fail at the 118 handle and we start to put in some type of consolidation or some type of topping pattern. Gold has yet to do that. Okay. So do you want to know why I think gold is outperforming silver right now? I mean, I don't mean outperformance in percentage terms, because silver has been crushing it this year. Year to date, silver is up. What year to date? I mean, embarrassingly, I want to say it's up like 30 to 50% or something like that. Year to date, silver is already up 57%. 57% in silver. And gold is no slouch, but it's certainly not up 57%. But gold is still up for the year, about 22.5%. That's good for an entire year in an index. That's great an entire year in an index, but it is a commodity. And it is behaving like the wild times that we've had in the history, where you talk about all these crashes and rips and capitulation moves in oil and gold. And now we have silver. Now we have copper. Now we have platinum. All these things are just blowing off left and right. So it's an exciting time. But as Nick said, and I will echo, it does come with a lot of risk. I do think that the risk right now is if you are in a heavy position near these tops, you're gonna hate that position, because any type of nasty volatility, you'd be better to just take a bite take a little bite, take a little nibble, dip a toe in the water. And if price goes and consolidates and then wants to break out, you can maybe take another stab there. But if we get a pullback, I'd much rather have one little test, trade my levels, invest an overall position again, and just let this market look like a technical, like a proper technical chart. Okay. I don't think that price will go up forever. And you know that it won't. I think that price, after getting this far removed from the 200-day moving average, this many bars away, this percentage away, that we're not that far away from having something a little shaky happen in the markets. And I don't know if that actually bleeds into equities, or maybe this rotation into gold, silver. It's like, because so much profits have been achieved, that maybe this starts to play into, you know what? Well, here's another non-US play. Here's another distrust in the fiat system. Here's another, anti-dollar play. Here's another decentralized, something that's a little bit of a rebellion play with asymmetry. If Bitcoin gets some love and drives it up, I mean, this is a pretty pure AI play, as maybe the markets and stable coins and stuff become a big reality here in the next 12 to 24 months. Okay, so look, I know it's exciting to talk about gold. I hope everyone's in it, and I hope you're all profiting from it, and I hope you're all trailing stop losses, because at some point it'll probably turn. I am the trader that's participating a little bit after showing that, yeah, I've had a pretty good run. I've been happy with gold and silver. Okay, what's funny is being happy after buying gold, and taking profit up here. Somehow I look at this and I'm like, I'm not happy anymore, because how did I miss that move? Well, this was part of my trading plan, was to start trailing into, my measure moves. Silver was to go from basically $20 to $50. That was my plan move. It got there. The fact that silver went to 118, holy crap, that's way further than I thought. But my plan was hit. My target was hit. So I took most of my profits. But I'm back in. I'm still participating. I'm up like 30, 35K in silver. I'm up like another 5 or 6K in gold. It's not a big position, but I want it to be, at some point, I want to be like adding back in, where I think this is a really good kind of permanent play in the portfolio. I think what's happening here is, because of the market caps, you're getting a lot of kind of exodus out of the bond market, and people are just parking it into gold. But I do think this comes with a lot of risk. I think right now you're flirting with some very overstretched technicals that I have to bring your attention to. I've seen this stuff play out before, where I've seen bar counts at 300 bars seem like a lot. Now we're at nearly 600. That is madness, But at some point it'll figure itself out. Like I said, I'm surprised that the VIX has stayed this low and this quiet and this contained, as the market continues to poke all-time highs. So right here, let's go up to this chart. Here's today's candle. Okay, so if I am right with this little rising wedge pattern, does the market, use this retest of the rising wedge to work its way back down in the next 30 to 60 days? February, March, April is typically a pretty good weakness window for the equities market, seasonality-wise. You'll see that in your edge finder. Additionally, by the end of this week, so we have an expected pause for the Fed today. We have Mag7 with Meta, Microsoft, and Tesla. We have Apple tomorrow. We have Chevron and ExxonMobil on Friday. We have PPI on Friday. And we potentially have a government shutdown at like a 75% probability. Another government shutdown. Is that good? I mean, if the market ignores all that stuff, awesome, I guess. But it just seems very weird that the market is going to shrug off like literally everything and just keep going higher in the S&P, higher in the Nasdaq, higher in gold, higher in silver. Because then I think that we would be, having this conversation. Let's say this does this for the next 3 to 6 months. I think I'm having a legitimate and educated conversation on an everything bubble, which means there's good stuff to happen. Like if this keeps grinding higher, that's good. But if we have a weakness window, I wouldn't be surprised to have some type of pullback here. Okay. Maybe some type of correction even further. And once this is done and troughs, then we have the ability to get back up to highs again and maybe higher, which I'd be happy. I'd love to see the market at, 7,500 this year. But if we can start at 6,200, that at least gives me some reward to risk that's favorable. I don't want to get to 7,500 like this. I don't want to get to 7,500 like this. That is not an enjoyable market. If we have super low volatility, I'm going to have to grind my face off for that trade, which is fine. but I'd rather have people get scared out. I'd rather get opportunities to buy in and stack up expirations like it did last year. Get the VIX up to maybe 30 or 40, and then see that thing retreat back to sub 20 and get a good volatility crush and also sell a lot of premium. So that could be nice for some alerts to come up. Okay. So we'll see what happens. I do have some interesting defense trades going on this week. By Friday, I'd like to see a price is either at or below 69.50, or I guess equal to 69.95 to, I'd say, about 70.05. I have some profit traps in those areas. And then today I put one on between 70.35 and 70.45. So all these levels to me by Friday close, these are big profit traps in my options trades that have anywhere between, trying to think, the minimum would be like maybe $1,200, $1,300 minimum profit targets. And if we're below 69.50, I have upwards of about $2,500 of profit. So we'll see. So if I'm below 69.50, that's kind of easy for me to have a net result. If we're at 7,000 or 70.35, or I guess I should say like 7,000 to 70.45, there's about a $1,500 profit trap up there. So there's some weakness in the middle, and I could get stuck in that. But by Friday, end of day, I'm going to be managing this stuff to figure out if I can carve out a net winner. Okay. All right. I think we beat up the gold, silver stuff a little bit. If you have any questions, feel free to throw that in there. Today for the heat map, right now we have 62% of stocks declining, and we are actually down. I mean, this week, what was interesting, we saw like 53, 54% of stocks declining, and the markets were going up all week because most of your gains this week, let's go S&P. Let's go so far. Can we do a 1 week performance? Okay. Look at who's leading the pack this week. Market cap is leading the pack. Microsoft is up. Amazon is up. Meta is up. Google's up. Apple's up. Nvidia's up. All these massive, $3-4 trillion companies are up in green. Why? Because they've been underperforming since October last year. So everyone talked about this big rotation into small caps, big rotation into mid caps, moving away from the Mag7. Well, you can see here that it's the drug you just can't quit. Everyone loves the Mag7. They got into kind of some oversold territories, and on paper, they're still very valuable companies. There's earnings coming up, so I think the market uses an opportunity to kind of front run the earnings that's coming out this week because they'd expect to deliver. Top and bottom would be pretty solid. Is it enough to rip to all-time highs? I don't know. We'll see. Let's go to Mags. Okay. So here's the comparison. So go Mags versus IWM. Okay. So when this is going down, that shows that the small cap Russell has been outperforming the Mags, and you can see that here pretty steadily since December, right? December to present, and then the last few days has been up. Go back to where this thing peaked here in October, November. It's been a big rip by the small caps and a stall by the Mag7. So that underperformance in the Mag7, you can kind of see that rotation back into large cap tech. Okay. If you go to Mags versus SPY, same thing. The SPY has outperformed the Mags. You go to Mags versus QQQ, a little bit outperformance in the QQQ recently. So a little bit of reflexive rally. A little reflexive rally in Mags recently, but very sideways here, Mags versus QQQ. Okay. So I guess that begs a question for me, like, do I want to stick to the big picture Russell and, be all in on small caps this year, all in on mid caps this year? My answer is no. I don't mind taking income trades. I don't mind taking a stab at it. But if we have a pullback to this level, that is a good spot to be buying small caps, right? Look at the trend. Okay. Look at support. So if I can sell premium down here, if I can add shares on pullbacks, then we can look to see if we get to all-time highs. My measured move is 300 to 325 on IWM. So if I can buy it 250, 240, 230-ish, take it up for 70, 80, 90 bucks a share, I'm pretty happy with that trade. Okay, but I want to pull back first if we get it. Okay, S&P. Is this a broadening pattern? Could be. I mean, it could be. I'll connect the dots there. I thought more recently we had what looked to be a pretty clean rising wedge. Okay. And this is the only thing that I'm questioning. Like, we just hit 7,000 on S&P, big milestone, intraday high. So if we are going to, celebrate 7,000 for a moment and then have a bit of a correction here, there's still really good support. There's still really good support in our moving averages to find a chance to buy a dip. Now, that would be like a seasonal correction, February, March, April in that window. If it gets a little uglier, if let's say we have a 1, 2, 3 wave move, look left on the chart. I think this is a good opportunity to buy. If you want to wait a little bit patiently, make sure this clears the trend line, then you start positioning for that trade. Get confirmation, stay out of the way, get back to these highs. Okay. If that doesn't happen and all this market does is grind higher, grind higher, grind higher, grind higher, that's fine. All I'm going to do is adjust that. And I don't love that chart. I mean, when this market is going to grind and grind and grind and grind, look, if we break the structure, we take out any lows, my concern is that we have a correction coming. So I don't like we're at all-time highs and we're staying at all-time highs and it just grinds, 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 grinds. The easier trade is get a correction, buy that dip, and then we're off to the races. But if it is just slow and steady to the upside like we had in 2017, that is not a fun environment to trade. It's a fun environment to hold, I suppose, but it's not a fun environment to trade if that's where the market is going. And I think that would be highly, highly manipulated, okay? And that will likely lead us to a lot higher volatility in the near future. So if you look back to 2017, that was 2017. What did 2018 do? Break, rip, break. It started to widen out. There's tons of volatility and lots of broadening patterns. And it went up to 2019, 2020, and then fell in COVID, and then off to the races again. Like, that was head spinning volatility for literally 3 years. All of 2018, 2019, 2020, until you bottomed out during COVID, and then this thing was off to the races. And what did that take? It took $6 trillion of liquidity to do that during COVID. So if it wasn't for that emergency measure that the whole world took, I don't think we'd have this movement that's 2 to 3 times higher. So 2017 was a challenging year because it was such it was almost like a forced, suppressed volatility market. And if that happens now, it's like, that's just because this market's in Goldilocks. It knows that the path of least resistance is up. It's going to be permanent vol suppression. And there are a lot of levers and forces that will kind of prevent things from running over. You'll kind of cap all the volatility. You'll cap all the outliers, and the market just continues to do what the market does best, which is trying to grind higher. So, we'll figure it out. And if the market is, going to go sideways and going to chop around and, going to have some plus or minus 2% or plus or minus 5%, that's fine. If the market melts up higher, that's okay. I mean, I've got some premium in. I will be very patient. I've got, systems in place that I'll take like a 5 to 10% buffer and try to basically scalp the market for, 30 to 60 day moves. So anyway, that's that. All right, that's SPY. Qs. Okay, Nasdaq just tested the recent all-time high, which is back in October. Again, with FOMC today, what happens? We might break through. Is this the same type of pattern? I mean, you could argue that that was a rising wedge, but it really wasn't, because we kind of broke the structure here. But if this is I guess you can call this high and this low, and this would be an ascending wedge. So what got us here were bulls, and this is where the indecision takes place. The bulls can maintain this and we break, well, then we're off to the races. And you can measure the move. You can measure the Nasdaq to basically this swing and measure that breakout, and we're talking Nasdaq probably substantially higher. Okay, but if it stalls here at the top, we're probably coming right back down to these 2 very significant candles and possibly a test to make it a 3rd significant candle. This was October 10th. This was November 20th. And if we settle back in for another, day of infamy, like a single day sell-off type day, I wonder if it's, down here again. But that structure seems to be very, very strong support for the market right now. Okay. So that was the 20th of November, 10th of October. We remember those days. Those were 3 standard deviation moves days intraday. And as soon as it was Trump tweeted about tariffs on China, Next, he tacoed it, and the market was up 3 days later. And then in 5 or 6 days, it was back to the top again. 1 day sell-off post NVIDIA earnings. We bottomed out the next day, ripped up. In 3 days, we're back to those highs. Market didn't even care. But it was a one-time move where the VIX was up to like 28. The VIX was up to 28, 29. After that, it retreated to 15. So this like capped volatility, like I said. Okay. Markets can play all sorts of games. We got to trade. All right, Dow. I posted some trades and Pulver alerts on the Dow. When we had a flare up in the VIX, so this recent spike up into the 20s, I did a trade on the SPY, did a trade on the Dow, did a trade on the Russell. I put a couple other trades in as well. I know we have some earnings this week. Like I said, Meta, Microsoft, Tesla today, Apple tomorrow. Amazon got pushed out to February. But the Dow, I'm using this April low. Using this April low as a chance to, if I'm going to own the Dow, I'm going to own it way down here. So my trade is, it's a ratio spread, which means I'm willing to own it with a big fat profit trap. I'd own the Dow at like $340. So is it coming down there? Probably not. So it's most likely going to be an income trade for me. So it'll help me make, $300 to $500. But if it dips, I'm going to start allocating, maybe buying some shares, keep this option trade running. And if we can, scale in for some shares, get this thing back to highs again, take the gain. I just don't like buying at highs, buying at highs, buying at highs, buying at highs. I don't love it. Russell. Great start for the U.S. and Russell, up 6.53 year to date. A little bit of a dip here, is up over 8% just a couple days ago, and now it's given back a little bit. Everyone's talking about this major rotation. I'd be careful what you wish for. I think small caps could do fine this year. I don't know if they're going to be 50 to 60% like earnings are expecting. I could see small caps doing okay. Could I see small caps up 15, 20% while the S&P's up 10%? Sure. 15, 20% while the S&P's up 5%? Maybe. But I don't see 60% without the S&P and the Nasdaq being up 15, 20%. And that's a possibility. We might still get there. But am I all in on Russell? No. But I want to buy some dips. So same thing. Do we have a pullback? Pullback, look for some dips. Off we go. It's established a nice breakout. It's cleared all the structure. Now buying opportunity, buying opportunity, buying opportunity, buying opportunity. If it channels out, trade the channel. Okay. Everyone gets in these trades and they think like, I bought it here. Well, if it pulls back, you got to be ready to buy there. That's the better trade. If it goes to all-time highs again, there is a potential channel, right? So do you take some profits? Maybe. Or you just wait to accumulate more until you have a profit target. And then you get out of your trade, which I'm happy exiting. Okay. But as we said, rolling into this year, it's like, this will be a good year for traders. I think every year there is always a lesson. Good or bad, there's always a lesson. So 2026's lesson could be, man, you talk about this crazy trap that silver and gold set. You talk about this crazy trap that volatility. We had all this stuff happening geopolitically. The markets climbing the wall where we're hitting all-time highs. And look at that 20% correction that came out of nowhere. Look at the Japanese yen, blowing out the. And it's not the Japanese yen, by the way. The dollar is what's getting blown out right now. The dollar. And by the way, how many of you are bearish on the dollar? Like, I'm talking in positions right now, trying to still push bearish on the dollar. Type in DXY bearish if you're bearish on the dollar. The reason I say that is because I don't think the dollar is going to be bearish. I'm not bullish on the dollar, but I think that the only trade that I like right now is maybe a little bit more downside on like dollar CAD, maybe a little bit more upside on New Zealand dollar, because my Aussie dollar hit my profit target. Dollar CAD still has room to drop to maybe 3,200. Euro dollar just hit highs. Pound dollar just hit recent highs. Dollar yen's been falling 650 pips. But look at this from the technical side. High, low, high, low. Here's your symmetry. Okay. I think that this symmetry is going to set us up with a flat pattern. So having this low, I think this market sets up some type of flat pattern in here before we maybe proceed lower. I think that this might just be an ugly kind of shock and liquidity grab to the bottom. I wouldn't be surprised if the dollar pivots here. I'm not trading that. Okay. I'm not long the dollar. The only one that I really like is New Zealand dollar long because it still hasn't hit my profit target. But if this is a fake out to the dollar and we head up to 100, 101, that could be what ignites a gold correction and silver correction. That could be also a little bit of a dip in the equities markets. But I mean, we know Trump is kind of ignoring everything with the dollar. We know the Fed is probably watching, but right now it's like the dollar getting weaker is almost acting the same as the Fed not cutting rates. If the dollar gets weaker, that's having the same type of international flows and improving exports and improving the other countries' currency positions as it would be if we were just cutting rates and we were being dovish. So it's almost like the Fed doesn't have to cut. We're getting all the kind of weakness and accommodation by just having a weaker dollar. Okay. The crappy part is the dollar gets weaker, you need the S&P to go higher. Dollar gets weaker, you need gold to get higher. Dollar gets weaker, you need Bitcoin to go higher. Because dollar getting weaker across the board, everything to do as a US, like you want to travel US to somewhere else, it's more expensive. Our cost of living at even inflation dropping to 1.18. What is true inflation right now? 1.16. But guess what? We've had 5 years of price increases. So to see this, you're like, oh, prices are not going lower. Prices are going up slower. But we've had 5 years at about 4% inflation. So now prices are up and are permanently higher. And so going at a 1.16, that just means that prices are going up slower. So unless this goes negative, prices get cheaper if we go into deflation. But the nice thing is okay, this is a big improvement, but we are at like a 5 to 6 year window of prices getting really, really expensive very quickly. And now things are kind of leveling off. But if our purchasing power continues to weaken, if our dollar gets weaker and prices stay the same, it's like, that's not good. So I do think like there is a legitimate narrative, like the sell the dollar, sell America, repatriating. I think that is what this world is kind of grabbing onto right now. Does it make me bearish on the U.S. markets? No, it doesn't. If anything, it's like the U.S. stability is good for the world. U.S. stability is good for the world. U.S. liquidity is good for the world. A weaker dollar is good for the world. This is why, late last year, we talked about having some international exposure. I am in SCHY, looking pretty good. I've been in this thing since the Liberation Day. And before that, I was in it, when this thing was moving around 25. I got the Liberation Day dip at 23. I've been holding this thing with a break even around 24 bucks. I mean, it's up $7 a share, but I've got enough shares that it's up a decent amount of capital. I'm also in, I'm trying to think, EWZ is Brazil. That's looking pretty good. I bought this thing at $25. ILF is Latin America. Okay, I bought this thing at 22 and change. This is all non-US. Okay, I'm in Japan. Break even is around 66. It's up to 85 bucks. I'm also in Fez. This is Euro. I'm in this thing since the 50s, like low 50s. It's up $15 a share. This is all non-US. Like, it's not all of my portfolio. It's probably added up to like 10% total of my chunk this year. So my equities exposure has about 10% allocated to non-US, but they're all doing really well. And I do wonder, like, if gold keeps running up, if silver keeps running up, if the dollar gets weaker, if the US markets are resilient and stable, but not necessarily gangbusters ripping bullish, non-US trades, like, this is their time to shine. I have an African one. I think it's what is EWK?
AFK?
AFK, that's right. This one. I've been in this one since 20 bucks. It's up to 29. So I mean, every one of those non-US plays, it's somewhere between, $10, $15 a share positive. Like, that's not nothing. That adds up pretty nicely. It's helping me outperform the start of this year because the S&P for the year, Nick, is only up like maybe 1% or 2%.
Yeah, I think it's like 1.5%.
Yeah.
2%. So
when you've got out of the gates, you got a lot of non-US plays up, 6, 7, 8% for the year. Gold's already up 20+%. Silver's up 50+%. Like, yeah, it doesn't have to be perfect. It just, now that you're on here, dude, I got to ask you, what do you think that we have a VIX event in the next like 30 to 60 days? Something just smells really, really funny to me that this market just can't do this for the next like 60, 90 days. I feel like something's going to have to like rattle this market a little bit.
I've been shocked to see gold do what it's doing without the VIX going insane. I've never seen gold make this kind of move this quickly without something going on. Like, when you think about, what was going on in post .com era and 2008, there was some craziness going on. You had some really high VIX readings. It's very interesting to me that you have sort of this bond market freak out taking place, and it doesn't have more impact on the stock market. I really think that this would have been, if you had told me like Japan freaking out, dollar index dropping like this, I would have actually thought the stock market would be down 5, 6, 7, 8%.
I mean, I would have thought so too. Look, I mean, that chart that you had up was a monthly on gold. Like that is, it's like almost offensive.
It's just broken.
Ridiculous it looks. Yeah,
it
for
is.
sure.
It's just insane. Chris, I was talking about this earlier. Maybe I'll share my thoughts with you again on this. Just from my perspective, because I know you do the same kind of thing. Every year around this time, I sort of talk about allocation and rebalancing of how I want to look at things. I know you like to do your pie charts and things like that.
Yep.
Just wanted to share this with you. I kind of have 4 things that are going into my portfolio in terms of how I'm thinking about things this year. I'm going to allocate a little bit more to the wheel strategy this year.
There you go.
Be a little bit more on the sell premium when I get the opportunity to. Macro momentum strategy, which is, where I'm trailing stops and things like that. I'm actually lessening my approach to that, which, it's been a phenomenal strategy the last few years to be riding trends. It's been a trend follower. It's kind of safe haven in some ways. But I'm also looking at ETF themes investing and stock picking, kind of allocating up or allocating, kind of diversifying things here. And of course, within this, I heard you talking about it, ETFs and stock picking. If you're talking about holding stuff longer term, that's where you have the opportunity. Like, do I want to go international? Do I want to allocate more heavily towards defensive types of ETFs? Or you have all sorts
energy.
Of
I think energy, you can't go wrong this year. Like we are, I think any volatility we see in 2026 will also be like the AI trade is the positive narrative. But if we have AI bottlenecks, if we have build out bottlenecks, if we have constraints where the energy grid is strained, we have rolling blackouts, we have this crazy cold front through half the country right now, like all these things in the US, I think it puts a strain on the energy side, which is good for energy prices. It's good for the scarcity. I mean, that's also why like gold and silver, copper, platinum, palladium, like all these things are running pretty hot. And I'll say this, when you see commodities running like this, it's typically not a strong bull market. Commodities like this are usually like the last breath of like, okay, this is cyclical. Something's happening. I don't know, man. I feel like we're talking about a lot of things that are also just breaking connections. We're getting like technical breakdowns. We're seeing like the weirdest labor market where what I see this morning that jobless claims are down, but like we're literally like seeing layoffs every single day. Like Amazon's laying off people, UPS is laying off 30,000 people, Amazon's firing another 15,000 workers. I mean, big tech hasn't hired since 2022. And it's still the same, the way that the trend is going. And we still have this like I wish we would get some labor data on the gig economy. Everyone that has a 1099, I wish we could figure out like how that plays into the BLS data, because it's misleading to tell everyone that you've got like a 4.4, 4.3 unemployment rate, and yet big tech is cutting tens of thousands of jobs. Our non-farm payrolls are embarrassing every single month. It is harder and harder to believe that our data that we're getting from the news is actually trustworthy and meaningful, and the market actually cares about it, because it's just not. Like, I mean, I'm reading Trueflation. That is a lot better gauge to me than looking at a monthly CPI report.
Sure.
So, and we'll see if it reflects it when it comes out next.
Yeah, you're talking about some crazy disinflation trend.
A huge drop. Yeah, huge
drop.
The
question is what gets a what makes inflation move like that quickly? Is it drying up of consumer spending? Is that what kind of gets you there? Is it weakness in the consumer? Is it oil prices, still relatively low? Like what gets it to make that kind of move?
Well, I'd honestly have to dive in a little bit deeper to like what they're actually pulling here, but I know they're pulling like thousands of data points. Yeah. I do think that every company right now that is talking about integrating AI in some capacity, the sectors that AI should be benefiting in now, obviously like tech should be the thing. But my fear with getting all in on tech is because the easy money in tech was made in 2025. I think 2026, you want the build out to be in, if we're going to have industries using AI, you want to be in healthcare, you want to be in financials. Those are the industries that would benefit from AI, because they're going to take away a lot of the paper, the paper pushers, the middle management, the executive assistants, like all that stuff can go away and be done by agents or one person. As far as the scarcity, XLB, XLI, XLU is not a cash cow, but I'd say XLE is going to be your energy play. XLU is not a cash cow, but XLU is going to be, I mean, if we have like blackouts and strain in the energy grid, utilities will do pretty well. The problem is they have such high overhead. I don't know if they can really add the AI component. So if I'm going AI, I want to be in the physical build out of AI, which is going to be these three. If I want to benefit from what industries can benefit from now having AI integrated, it would be healthcare and financials. And then utilities would be just kind of the safe blue chips, like the safe dividend makers, the safe, kind of I mean, I'll call them like cash cows. Is they're steady, they're low beta, they're low volatility, but they tend to perform well, especially when they're, needed by everybody. We don't have the proper infrastructure for a booming AI. It's like, we need to build this crap. And that's what is so exciting about this whole revolution, is a tech revolution that is probably truly more important than the internet. But if you remember what happened with the railroads, remember what happened with laying the fiber for the internet, guess what? It left casualties and victims that were thousands of miles wide. And afterwards, those that survived became some of the strongest companies in the world. But I don't think you can pick the top dog here, Nick. I think you have to pick like the sectors, the industries, the scarcity, and benefit from the market as a whole, as this becomes like the positive narrative. But I don't think you can pick like who's going to win the AI race. If it's one company, dude, I would never be confident in that pick.
Yeah, and I'm with you on that, because I would have a hard time. You and I, our specialty is we stare at financial markets all the time. There's people in the AI world that know so much about it, and they will struggle to pick the right companies to determine, which ones are the best technologies. And, last year, everyone thought Google was down and out, and then it turned around and became like the best AI model.
Right.
So
now it's better. It's better than NVIDIA, Gemini.
Right.
Yeah.
So it's almost like maybe the strategy, I'm with you on that, in terms of if I'm going to pick an area, it's probably going to be through an ETF. I've told you this before. I like the idea of buying cybersecurity. If we get some sell-offs in the market this year, I would probably be hitting the bid a little bit on some cybersecurity as a collective group, like the cyber ETF, CIBR. It's already been down a little bit. I would just love to see if people got a little worried about a hawkish Fed, if you got 20% off, 15% off on the cyber ETF, I'd probably go a little shopping in there and feel decently good about it. But yeah, to your point about the build out too, right? Like if we take a look at, it's a really interesting time, because if you have this circumstance where we are going to go into a spending super cycle. We have Japan doing it, right? Talking about they want to be more aggressive and they want to grow, and they're willing to expand national debt, which is already massively high. There are serious risks to there, but that risk has the potential reward of Japan kind of coming back to life. It's kind of the same story in the US, where it's a risk because the administration wants to spend like crazy, and the hope is that we can outgrow and that we could potentially become even more centric to the global trade again, strengthen the dollar, et cetera, longer term. I don't know. It's an interesting story. But the point is that if we're going to give that a shot, if that is going to be the attempt of the administration in the few years coming, that's a lot of spending that goes into industrial. It's a lot of spending that goes into energy. It's a lot of, build out, because that's where the money would go, right? If we have this one shot, is like, you got to win the AI race, just like the space race. That's a ton of fiscal spending. And hey, maybe there is massive boom cycle growth on the other side of it. Maybe it's not necessarily equally distributed wealth. I would say almost certainly not. But the point would be, if AI if the US is going to go all in basically on AI infrastructure, that's a huge spending cycle. And with lower interest rates, I mean, that's where it's like, it's hard to get, for me, really bearish on you're in that case. You're talking about a secular technological trend. You're talking about a fiscal policy that wants to spend like crazy, and the Federal Reserve that most likely wants to continue to cut interest rates. That's a tough wall of bullishness to like get very bearish on. Now, I'm not saying that, we should just go out and go all in on the stock market. I'm just saying constructive dips. I'm a buyer of dips if we get healthy corrections, healthy pullbacks this year.
Yeah, no, I agree. I think and ultimately you have to stay the course, because I think that's where the market is going. I think the market is, because of all the things just mentioned, it is going to be tough to turn the, the Titanic to a bear market. I think that you keep plugging away, you crack through some icebergs, and you keep forging forward. I think the only thing that maybe puts a wrinkle in that is the fact that our debt is continuing to climb. The debasement continues to accelerate. And, right now it's like, this is a big window for the US to be lapped by the world.
Mm-hmm.
And I mean, for us to sit here and brag, like, we're going to lead the world in AI, it's like, well, but our dollar is 20% cheaper. Our gold is outperforming our entire index, and GLD is the best performing ETF the last 25 years outside of our S&P 500. Like, that's embarrassing.
It is,
but
crazy.
that could be the reality here over the next, last year to this year. If gold continues to run like it is, I mean, dude, GLD over SPY could be like a 25 plus year. Like, if you look at the long-term performance, you could have, I mean, I guess we could just put it on the chart. Let's see how far back this can go. Let's go GLD versus SPY and go back on a weekly time frame.
2005 to now, gold is winning.
Yeah.
Crazy.
It's nuts, right?
From 2005 to now.
And if this has anything to do with a rally coming that's going to continue, it's like, could you imagine what this looks like for, gold holders with like that type of like outperformance? I mean, on a positive note, it's like, that's why it's great to have in the asset. It's great to have in the portfolio, because it's one thing where if you just think about, if I want to save money, if I just put some money in gold and it maintains my purchasing power, in fact, actually appreciates and gives me more purchasing power. Like, I can take less gold and buy a house now versus what we have in the dollar, which is it takes more dollars and more dollars and more dollars to buy anything. So less gold to buy a house is great. Less silver to buy a house is great. Less Bitcoin, hopefully, if we hit all-time highs, is great. But I think this is, I don't know, man, the fact that central banks are net long, biggest banks in the world are net long, there are definitely some tailwinds. And all I'm saying is please just give us a correction. That's all I'm asking for. Just give me a chance to feel like I can get a better allocation into this after, being patient for 3-4 years and trading what I thought was a good trade, and somehow feeling like, man, did I really like mess up this trade?
Right.
I followed my plan and I still like feel like I didn't do well enough.
Yeah, no, I mean, and for listeners, Chris has been playing gold and silver for years now. You did excellent with it. It's just the chart absolutely broke. Like something just really the structure of this thing completely broke to the upside. Silver, gold, etc., just completely crazy. One thing I'll say, Chris, to balance out what we were talking about, the bullish case, right? The idea of fiscal spending, the idea of the Fed, the idea of a continued tech build out. I agree. Actually, you probably want to see it rotate into other sectors for it to keep going. But one thing I would say, the biggest potential risk to me in the markets, not any surprise to our conversations, is going to be the bond market in the U.S. and Japan. I think that's like front and center this year for me. Is if you get a scenario where not necessarily just the nominal rate, but if you were to see interest rates in the U.S. start to go on a run, like to the upside, meaning the bond market gets sold hard. If we see something like what's happening in Japan, if that happens in the U.S., that to me is a reason to get defensive, because historically speaking, we say it all the time on the stream. The two things that actually cause tangible market sell-offs that historically speaking have caused them is a blowout in oil prices due to geopolitical events, can cause spikes in inflation, and the other one being a very rapid rise in interest rates.
Right.
So if the Fed were to have to, I heard you say it earlier, if the Fed were to have to pivot and start hiking interest rates for whatever reason, no, it's not tomorrow. And I think that's why we still have runway to this market. But when that starts to shift, that's where I think we have to actually take a closer look at, being cautious on the market.
And I think for the bond yields, I mean, U.S. and Japan are the two biggest markets that are probably being watched the closest, because, I mean, the U.S. is now 120% plus GDP, debt to GDP. Japan is 200+% plus debt to GDP. Two very liquid and solvent financial systems. I don't think the market really cares, Nick, if we're between 4% and 4.5% on the 10-year. I do think the market cares if we're at 5%. What this market is telling us is, look, you guys want to run these fiscal deficits, you want to run these debts, you want to print money left and right. We want more premium. You want us to hold your debt? You want us to hold your treasuries? Give us 5.5%. Give us something better than what you've been giving us. And it's tough to service that, dude. I mean, when you're talking about the US especially, I mean, right now, like our interest expense on our debt is one of our top 3 line items. It's as big as the military, maybe even eclipse the military. But now Trump wants to do another $1.5 trillion to boost our military spending. Like, where does that money come from? I mean, it gets printed. I mean, we've put like 20+% of global like fiat circulation in the world. Like we've added like another 20% since 2020, just the US dollar alone. Yeah. Like it's crazy what we're doing. So, but I mean, I'm trying to think of the exact saying, you know, the governments will continue to spend until the bond market takes away the keys. So the bond market, like you said, like it will ultimately be the thing. And I think that the big threat to the bond market is higher inflation will change everything. Yeah. So right now, like we are getting lower inflation. We are getting, you know, real readings showing a depressed inflation, which is good. But if this starts to spike up again in any way, shape, or form, it will change the dynamics of the bond market. I mean, we need some type of inflation to grow. And we know the most volatile aspect of inflation usually is energy, right? So that's where we go back to what we just talked about. It's usually a blowout in oil prices, which not always, but you know, historically that can be a major deterrent to the overall markets. So right now, not a huge issue, but something to continue to keep an eye on. Chris, just a quick look. We do this every time we're together. Take a look at some sentiment here. Crowd sentiment still pretty bullish on this market. 43.2% of market respondents to the investor sentiment survey, marking that they are feeling bullish on the market in the next 6 months. You only have 33% of respondents saying they feel bearish. Of course, this is not necessarily a perfect contrarian indicator, but it's something that we pay attention to, especially when you get a reading like 49.5%. That is very, very bullish sentiment in this market. And just to also layer onto that, the put call ratio here, taking a look at this one, you can see S&P 500 hitting the call volume bid here recently. So we are seeing a little bit more favoritism towards upside from the crowd. So I would say, you know, that continues to keep me a little bit cautious. I when it comes to stocks, I'm loving the idea of a pullback if it takes place. And I kind of see limited upside personally with the whole Japanese bond market stuff that we keep talking about in the short run, or at least I would only really be enticed, say it another way, to potentially get long or add stuff to my portfolio if you were to give a pullback first. Sure. I think that, you know, maybe a replay in some capacity of 2024, that July to August window where it was like the yen trade is unraveling, the carry trade is unraveling, and the market had a flinch reaction for 2 weeks. The Nikkei was down over 20%. The US market dropped 10%. You know, that was a nasty move, but it was quickly resolved within like 10 days. And then we're back up to highs and we never stopped going up for 2024. I could see something like that where it's essentially a flare up. Like that was a 2024 volatility event. If you bring up the VIX here, you'll see that spike in 2024. That was July to August. Look at this. It's like you couldn't even trade this VIX because it happened like over the weekend. I remember that was the July to August. That was a Sunday night futures open where the markets were down like 4 to 5%. And then as soon as they opened up on Monday morning, down 4%, they ripped up to like close the gap and they never stopped going up. So, but it was a one-off VIX event. And that was like I said, it was like the carry trade unraveling. So they said, and it was right back on after that, dude. And then it was like here's Liberation Day. And the fact that we are just suppressed volatility, I just think like the market's probably going to give us another one of these this year. I don't know what it is. It could be Japanese yen bond related. It could be yield related. It could be gold related. I have no idea, but I'd be shocked to see the VIX do this all year.
Yeah, me too.
That'd be really surprising.
Chris, what do you think about the dollar? Dollar blowout to the downside here recently, 4-year lows.
I think it's a fake out, man. I really do. Yeah. So here's why. I think the fake out is high, low, symmetry got hit. I think this is still playing around with a flat pattern. So I think we still have to spend some time in this consolidation before this maybe turns permanently lower. To me, this looked like with today's candle especially, and it could be, look, I could be wrong. And how am I wrong? If it goes lower, I'm wrong. But if this is lows that are getting tested again, like that low got tested during FOMC and it went up. If this low gets tested and then we put in a bottom and the dollar starts to work its way back up, I think we're stuck between like 96 and 100.
Yeah.
So I just think like, you know, for a short-term trade, if you're right, and this is dollar strength, that's a very low risk, high reward trade. If you're wrong, get out immediately. If you're stopped out with fresh lows, like just get out. Because if this does break out, you can see my measure move here in the boxes, high to low, high to low. If this is a wave 4 pause and this is a wave 5 continuation, I've got a measure move down to 87 on DXY. There's plenty of downside pressure there. So the one trade that I like right now, currency wise, is I like New Zealand dollar. I've been long this thing since about 57.50. We are getting closer to my measure move target. I think we get up here to like 61, but also I like this level all the way to 63. This one is one of the only charts I'm like, okay, we still have a few hundred more pips that I can measure. So I think New Zealand dollar buying dips going up to 63.50 or so. I think that's a really good looking target. Nice. Dollar CAD has room to fall a little bit. We started to roll over here. Dollar CAD could fall to like 32.50. I mean, oil prices are up a little bit. CAD economy is always questionable. I mean, I listen to some smart Canadians that are like, the U.S. thinks it's bad. It's like the Canadian's way worse. Canada's way worse. Sure. Their people are happier. The people are nicer, but their economy is also kind of a mess. So anyway, there's still some room to get down here, but I'd say I like the New Zealand dollar better. Just in terms of commodities, I think in terms of proximity to China and Asia, I think New Zealand dollar is looking good for another few hundred pips to the upside. Aussie dollar, it hit my target. I was long in here on this chop. We talked about this a lot last year. I can't believe how slow this thing behaved, but I was long. I wanted to get longer at like 6,300, 6,250. Never got the chance. I just stayed in here with these like little dips at 64.50. And I hit my profit target at 69. So I'm out of this trade. But it was stupid the way it was so slow and behaved, but it did ultimately hit my profit target.
Yeah. Forex trading 101. Chris, you've been trading Forex almost the longest thing you've been trading, right? It's you started in stocks?
2000 was stocks, like, just dipping my toes in the water as, I was a kid. I was 18, 19 years old trading stocks with my brother, and we got a little investment club going. Right. But when I was like starting to really cut my teeth in trading, I was learning from a professional day trader that was running like a $25 million currency fund.
That's right. On the golf course.
He was a member at Doral, and I was in Miami at the time in Coral Gables, and I saw this guy every day. We traded together. We played golf together. It was, taught me a lot, and I got really excited about, I'm going to try to figure out how I can trade. So I worked my butt off and tried to make as much money as I could. Had a little nest egg so I could trade, and made some pretty good money in Forex, and had a couple years that was like lightning in a bottle. And once I got to that point where I was looking to preserve, and we had survived the great financial crisis in that little investment club, and I looked at like, how do we protect that? Like, I mean, our portfolio was down like 40% in 2008 in stocks. So I started looking at like, how do you protect that stuff? And instead of losing all that money, we buying puts or selling covered calls and basic option stuff. So it all kind of came together like 2011, 2012, adding more dynamics to my stock portfolio, incorporating options. And then once I got into like 2014, 15, 16, way more familiar with income trading, and I didn't want to really own anything in stocks. I just wanted to trade options. And then currencies, I ran a fund from like 2011 to 2022 is essentially when I called it quits in like a managed fund. Reason why I called it quits is because my brokers kept switching servers on me. My robots kept getting disrupted. And I had multiple disruptions on spreads, commissions, margins getting changed on me. And I'm just like, you know what? Like, F it. It's so inconvenient to trade Forex right now. I have way too much money in it, and I'm going to start diversifying away from it. So I got everyone into, mostly indexes, stocks, options. And, Forex is just a sliver now. But I still do well in Forex. It's just, I don't need to put that type of emphasis on running an $8 million currency fund that I trade zero leverage and have no control of what the brokers can do. Right. They increase margin by double, triple overnight. That's not good for me. I don't like to use stop losses. I like to trade very small. I'm very responsible. And I still have positions that like, oh crap, I was down, 3% drawdown that just turned to 6 or 9% because of margin requirements. Like, that's bullshit to me. Yeah. So, and you talk about robot trading. It's like, I've had my servers probably changed on me a dozen times, and I have open positions. And when they disrupt my robot, they disrupt all my open trades. I got to go in and manually take care of like hundreds of positions. It just became a huge inconvenience. And I'm like, it's not worth it. So I started just scale that out strategically where, I trade currencies. I still got a 6-figure account that I look after. And that's fine, but it's like, it's just a fraction of what I do now. Yep.
And it's currencies, in my opinion, best way to trade them is to be really boring with it. And So anyways,
Yep.
we just had rates come out as expected. So no surprises there. And if you're newer to these types of events, if it's your first day trading a Fed day, or you're new to this stuff on the fundamental side, usually this doesn't cause a big move.
Right.
Markets are pretty dang smart. They've already figured out quite a while ago that we were unlikely to change interest rates. What's more likely to move the markets is the unknown, which is the press conference.
Mhm.
So the press conference in 30 minutes, we share this breakdown every time we do these streams. This first move is usually not a very big mover. It is usually the press conference itself where you get the more decisive reads. The way this works, the market is always looking ahead. And so by the time the day of the decision to cut, hold, or hike interest rates gets here, the market's already figured out what it's going to do for a very, very likely probability, like a 99% chance today we knew Fed was going to hold rates steady. The bigger question is the guidance for the future. Where are we going with interest rates? The market cares about where we're going, not where we are today. And so with that said, in 30 minutes, we have the press conference with Jerome Powell, which is going to be one of his last press conferences. And probably we are not going to get another interest rate cut from Jerome Powell's from leadership until the next cut will probably take place under the next Fed chair, which is actually leading now is to be Rick Rieder. So we'll see, at least in the prediction markets, what that brings to us. So far, market reaction, you have S&P 500 not really moving too far. This is an hourly chart, so the last 1 hour we haven't really seen much of a change. Nasdaq, same thing. Bitcoin continuing to be a little under pressure here. If you take a look at gold's taking on just a tiny bit of pressure here. Same with silver. Oil's flat, and dollar index somewhat firm here on the rate, remaining unchanged for now. So press conference will be more interesting, I think. And until then, we'll continue to watch these charts for any major developments or major moves. Chris, what do you think about you gave a response non-verbally to Rick Rieder. Do you know much about him? I don't really know that much about him.
No,
He's a super dove.
I just know that the same days where everyone that's in the Fed and the government has been pulling from Goldman Sachs, now they're being pulled from BlackRock. So, but no, I saw a funny. It was on Twitter X. So it was like, this guy's going to cut rates 25 basis points for every shirt or every button he has undone in his shirt. Because he went on, it was like 3 or 4 buttons down. I'm like, talk about a casual, like a business casual attire. It was just a funny joke. But no, I mean, I know who he is from BlackRock, but now he's getting thrown in the ring. It's like, I don't think anybody really knows who it's going to be. I really don't care. I don't think it's going to matter. I think that if you look at what the Fed is doing, remember, it is a council, right? Like it's 12 members. So one chair does not, like, one thing that Powell did, and I don't think this was really the intention of Powell until things got really disruptive between Trump and Powell. Powell became basically like an empowerer of the Fed members, because he's like, look, go talk, do your rounds, say this. Like, I just feel like all the Fed chairs, we had dissent under Powell, like way more than before. And I don't think that's because of a disconnect. I think it's because of more transparency. And I don't think the market loves that. I certainly didn't love it. It's nice when a Fed chair just steps in, says something very vanilla, and it is what it is. But so much indecision, so much wait and see, so much, what is the Fed going to do? And it's like the market it just sits and waits for like, oh, it's a Fed decision. Let's see what happens. But right now, I mean, basically under Powell as chair, nothing's going to change. And we get into June. It's like, okay, so this window from June to October, maybe one cut, and then maybe one more by the end of the year. So that's where we're at. It's like, and the market's already anticipated this, and those priced in last year. I think when the Fed started to end their quantitative tightening, started adding $40 billion back into the markets, and they forecasted 2 cuts potentially for 2026. I think the market, that's why we had such a strong bottom in October and November after we had those like single day sell-offs. But here we are, maybe a 1% higher. The market's obviously down net on the day, but nothing's really going to change until Powell is gone. And I think that, again, any comment from Trump saying we need to lower interest rates.
Sure.
Dude, you can say it all you want, but it doesn't change the fact that the long end of the curve is not going down.
Yeah, and there's some mechanical things I've been thinking about too with the whole Japanese bond situation. If the U.S. cuts interest rates and the long end were to come down, does that not put more pressure on the yen carry trade if you're getting less yield on the carry side. Meanwhile, Japanese 10-year is rising. Doesn't that potentially incentivize an unwind in regards to the carry trade? It's something to at least think about.
It does, unless the U.S. is behind it.
Sure.
I mean, look, one thing I looked at this morning, and I couldn't bring myself to do it, Nick, but I wanted to buy Japanese yen futures so bad in the last 30 days. Like this has been on my mind, but this is what it just proved to me. This chart of 6J, which is Japanese yen, it is the inverse of the dollar yen. It is not the yen basket. So if you look at the yen basket, they're not all correlated. Everything is now showing dollar yen movement, and the Japanese yen futures market is because of that dollar yen movement. So I didn't trust, and rarely do I trust the yen, but I didn't trust that the yen would move as a basket. But what we are seeing is the dollar's making that big move because the dollar's getting weaker. I would still take it a fine risk trade at it. I don't know if I would trust it enough to say that we're going to have this huge unraveling, because at the end of the day, here's what it means. If you want to get long the Japanese yen, or in fact, you want to get short the dollar yen, do you think that if the dollar yen were to drop 2,000 pips, that the equities market should be sitting at all-time highs?
Probably not.
Probably not. So that's why I can't take the trade, because I don't think that that's actually going to happen. I think the markets are still going to find a way to grind higher. And all the stuff on the yen is going to be noise. We could have it be a catalyst for a short-term correction, but I do think that the U.S. and Japan will probably have to work pretty closely to make sure, look, you guys are going towards this debt bubble. So are we. Let's not F up the entire market. I think there's going to be some way they got to figure out how to creatively account for what they're heading to, which is just like this debt spiral.
Yeah, I think it is a more collaborative thing than some people are thinking about. The Japanese situation is the U.S. situation, right? The Japanese are the biggest international U.S. Treasury buyers. If you have a giant customer, you're going to try and take care of your best customer, right? So, it's an interesting dynamic, to say the least. We'll see where it all goes. Watch that. The yen is weakening off here a little bit here. Taking a look at the JXY, gold, silver, of course, we already talked about, just flying to the upside. What about the Nikkei? I'm long the Nikkei. I have a small long position on it. My thought process is just from my limited understanding of Japanese fiscal spending, it's somewhat similar in the idea that you have a fiscal policy government that wants to actually try and grow Japan. It's so fascinating. There's so much commentary on this. I've been listening to a lot of it. So much commentary around the strategy for Japan, and they're taking the high risk, high reward type of approach right now, where the government, the leadership there is like, all right, let's essentially keep monetary policy, let's keep fiscal policy very loose to try to start growth in Japan again. And it's an interesting one, because what that does is as we've talked about just a moment ago, the bond market here is, okay, so you're going to spend like crazy, and we need a higher risk premium if we're going to lend money to the Japanese government, which is going to spend like crazy, potentially devaluing the yen worse. We want higher premiums. So it's a fascinating dynamic. I think that the yen weakness is likely to stay there. I think that if the Japanese government is on board with wanting to keep spending going, competitive on global stage, I like the Nikkei. So I have a long position with a small stop. I'll cut it if it breaks. I want the thing to keep moving with momentum. Otherwise, I'm out of the trade.
I like Nikkei long. I think the smartest thing for me to do in currencies is just not do anything on the yen. I don't trust it enough. I don't trade it well enough. I just know, I know myself. Like, I'm a much more like pure structure, technical efficiencies, pocket type trader, and the yen doesn't behave like that. So it is not the currency for me. It is if you trade what you see, that's how you trade the yen. Have a stop loss, have an exit plan, go with the flow, stick with the alignments. But that's not my style.
It's very trendy.
But if you're like that, like, trade the trend. When it starts a trend, it'll last for 3 to 6, 9 months, and it will be like 1,000+ pip trend. Those are great. But when you have also 9 months of chop, that'll drive you crazy when you're just waiting and begging and looking for a move that never happens. It's like, I just see more people get beat up so badly by the yen because it's all or nothing. It's all trend or it's all chop. And it's just so inconsistent for me that, look, and I've spent a long time trading currencies. I can say I've got 18 years in the currency market, and I've had plenty of bad experiences with the yen. It's probably been, if I could reduce those to like, one bad lesson, and not more than that, then I wouldn't be so offended by the yen. But it's just a challenging currency pair when you see it do amazing things and you want to jump on board, and then you realize, oh, it does that whenever it wants to. It's not really something you can predict. People have been like the carry trade stuff. It's like people have been long dollar yen since I'm trying to think dollar yen here. I mean, when we had like the test at 140, or this run from like, 140 up to 160, or heck, the 120, the 120 to 150, that was a beautiful trade. But notice how that happened over the course of maybe a year. And then we have gone literally nowhere for the last 2 years.
Yep.
Nowhere.
Yep.
So it can drive you crazy. That's all. I call it the widowmaker. I know that everyone calls natural gas a widowmaker, but I call the yen the widowmaker for currency traders.
I think that's a totally fair. It's very volatile. It can and move very, very dramatically. Just an update. There's so much to talk about. We have precious metals. Currencies are actually interesting again right now, at least in my opinion. There's some real interesting stuff going on with the dollar and with currencies. One thing that's happening right now, you've got Nasdaq sitting at all-time highs or trying to claw back to all-time highs. We've been in a sideways market for the Nasdaq. It's been a long time since we've seen one, but oh my goodness, we've actually got, let's call it 3 months or so where you've had the Nasdaq kind of trade sideways, though now we are back to the upper end. The question is, are we going to get head and shoulders back above and start continuing this grind up in the Nasdaq? I think for me, I'm cautious. I think that I'm not willing to short the things in a longer term upward trend. Just plot your moving averages. You've got a long-term upward trend here. We have retested. This is kind of an ugly but choppy pullback that seems to have gone on right now. Sitting at all-time highs. There's a lot of growth stories that are going around that I think are great. I'm just a little cautious on valuation, and I think the risk to reward is just a little sketch with all this bond market commentary. That's my thought in terms of investing. From a trading perspective, you get the solid breakout to the upside. There may actually be some opportunities here with a tight stop, trailing stop, to see if we can keep running hot on this stock market. So I lean neutral to slightly bullish.
On Nasdaq. It's a pretty clear level. If we clear the highs with a closed candle, I think there's room to run. If we show this rejection and we finish up this month and we have a fresh month of February, that unfortunately that first week of February is going to be kind of a make or break of whether or not we do break higher, or if we we had a good run, good flows, the leaps are done. Now it's time to see where the market has this weakness window. All of our big corrections we've seen the last 10 years have all have come in some way, shape, or form between February to April.
Yeah.
COVID did it. 2022 rolled over in mid-January. 2020, I'm trying to think, 2025, the weakness window was literally March to April. It's just a pause. And so that pause can turn into something worse. I don't think it's going to be out of the ordinary to see 5 or 10% fast in 2026. But also just as fast as it goes down, we could also have the everyone's conditioned for a taco trade now. So hopefully it's going to be another one of those opportunities to buy the dip. Pete, Tom Lee's on it for fun strat. Anything in 2026 is an opportunity to buy, which I agree. It's just how ugly does it get, So One thing really quickly on my day here, Nick, I was calculating this morning on SPX. So, the Fed is kind of big nothing burger. We have earnings coming out after market. Microsoft, Meta, Tesla today after market. I do think that for the S&P today, we poke 7,000, maybe a, kind of an internal celebration for the markets that we hit a big round number. We retreated a little bit, not by a lot, only 30 points, which is not a big deal. FOMC is moving nowheresville. And then Powell comes up in 15 minutes to see if he says anything that the market cares about. I think it's still going to be just a big, fat, nothing day. Then we have earnings for the rest of the week, and we'll see kind of where things fall after Meta, Microsoft, Apple, and then energy on Friday. But that's going to be the first month of the year. And then February, I just think, I guess we can go higher, but I'd rather see a dip. I think I'd like to see one because I want to trade it. I'm not saying I want to see one because I want to deal with a drawdown. I'm just saying I want to see a dip so I can actually position for it. So I don't want a 2017 type year. I don't want the market to grind, fractions of 1% higher all year long and finish at like 11, 12% for the year. I want it to be like either give us a dip so we can have, if it pulls back 10%, we have an 11% plus rally to get back to those highs and then some. Great.
Yeah.
Most
traders don't love years like that for good reason. It feels like a waste of time. You should have just been sitting in the index, So a nice year is where you actually get some volatility and a trader can actually carve something out of the market, as opposed to, if you just get an everyday up by 0.25%, 0.5%, it really feels silly to be trying to trade because the market itself is just, and that always happens every time people, I've seen this for years and years and years. Whenever the market has had a really good stretch, you'll see comments of people saying like, what's the point in trading the market? You just do better sitting in the market. And then nobody's saying that when you have a 2022 or, everyone's a stock picker's genius when you have really great years.
Right.
But then it's, a lot of people give that back during down times. Anyways, speaking of markets breaking out and doing really well, Chinese stocks flying here. Chris, you were playing Baidu the last time we talked about it. I think you.
Yep.
What's Baidu doing? Is it doing okay?
It's doing great. I am out of my chunk of shares on Baidu.
Okay.
I am just sitting on some naked puts down here at like it's a ratio spread, the 90 by 85. And I'm just kind of doing like a reset because we did spend a lot of time not breaking this 155 handle. So, I mean, Baidu is technically one of my favorite setups because this low to high, if this is a double top, we break that level, this is going to double and probably be a $270 position. I've got it measured here, 240 to be my target. So I am bullish on Baidu, but expect there to be some, wild and crazy, maybe channeling along the way. If this is how it plays out, I could see that happening. In also typical stock fashion, if we break here and it gives you a chance to buy in, you want to get long that because that's open space. So that could be a big runner in Baidu that I'd be okay with. I don't know if I love it that much because fundamentally, here is Baidu fundamentally. It's okay. Earnings are going to grow. It's cheap as far as price to earnings, but not super cheap. It's more expensive than Artec. And then we have, cash flow and discounted cash flow, $100 fair value. It's like, I don't want to chase this thing to 240 when I made all my money from 80 to 150. Like I'm happy being out of the trade because I closed out my shares. Now it's like, if I'm going to take a stab at it, it's going to be down here. It's going to be down here. Like I'm probably not going to chase that 150 to 240 move. It wouldn't surprise me if it happens, but I'm not going to hold and hope. So that's Baidu. Baba's the other one that I've had exposure on. And this one is also like, it's funny how the timing has been totally different. This one's been up and down and up and down and up and down. It's a nice channel. Okay.
Yeah.
It works out well. But, this was happening like Baba outperformed here. And now you see that Baidu's at fresh highs. It's just like it's almost weird how they just cycle back and forth. And they're still like, one is the Google of China, one is the Amazon of China. So they're not the same company, but you look at our Google and Amazon, they're also not behaving the same way either. Yep. So I think they're two good plays. It's just, pick your battles, sell some puts. That's it at this point. You've had a good run on shares. I mean, and this, Nick, like I was early, man. I was early to this Baba stuff early. I mean, I was in this thing since 2022 when nobody liked China. And I was like, all right, I'm going to take a stab at it. So I've held it for 3 years and finally got paid pretty well, but I don't need to chase this thing any higher.
Yeah, Chinese stocks have been, it's an interesting place and we'll see, weaker. The reason I asked that is because I was going to come back and talk about the dollar for a second again.
Yep.
Weaker dollar, I was looking at a chart. I mean, it is pretty inversely correlated with the performance of international stocks. And so when you're talking about weaker dollar, that's usually good for international stocks. When you're talking about stronger dollar, that is talking weaker for international stocks. We've had, for the last quite a while, last decade or so, you've had a strong dollar. And so if we are, actually challenging dollar downside, how far does that go? And so I think it's kind of interesting because I have a mixed view on the dollar. I don't see a giant drop off in the dollar that's going to last, a decade.
Right.
Personally, I think if we're looking at two quick indicators, these are new indicators. I think you might have be talking about this, Chris. We worked on this over the weekend and I'm really excited about them. But this is the new, Edgefinder's Economic Surprise Index. Really simple concept for people who are familiar with surprise indexes for economic data, it looks at all the edge finders economic data, and it looks at the percentage of those indicators that are stronger than expected versus weaker than expected for the currency. And what's kind of interesting is when you look at the dollar by itself, it's been outperforming expectations. The challenge is there's a lot of currencies actually coming in really strong. New Zealand dollar coming in very strong versus expectations. The euro's a little upbeat here relative to expectations. Australian dollar, it's actually the Swiss franc getting a really weak reading compared to expectations. And then the Chinese yuan, which is interesting. So you just have this scorecard here that's looking at CPI, PPI, PCE. It's looking at GDP, NFP, like all these different major economic data points to build a surprise index. We've also added this chart at the bottom here, which will show it over time. Now, we just started tracking data, so we don't have a lot here, but over time, you'll be able to look at currencies over time, which ones are sort of building economic strength momentum relative to forecasts from economists and which ones are underperforming. Then there's one other chart just to show you this one. This is where I actually kind of see on a longer term basis. Sure, we could have some downside in the dollar, but I think it's limited in the longer run because this is the economic strength index. Now, what this indicator does, it's a longer term fundamental indicator of currencies. And what it looks at is a relative strength. It has an algorithm within it that looks at relative strength across GDP growth, unemployment rate, interest rates, and CPI, as well as real yields internationally amongst the major currencies. And what's really nice here is this is building a little bit of a profile. You mentioned like Canadian dollar getting some weak readings earlier. Like there it is. You have the Canadian economy is seeing higher unemployment rate. The real yield in the Canadian dollar is actually negative when considering current CPI and interest rates. And so this kind of shows you on a longer term bet. I actually, you know, our good friend Rob Booker, I heard him say in an interview actually recently, is like the only game long term in currencies is the real yield game. And I thought it was a really smart point. And so, you know, I think it's a good point. So anyways, GDP growth in the US still strong, unemployment rate low, interest rates. Like if you just know not everything is perfect in the US.
Correct.
But if you sort of look across the lexicon of currencies, the dollar to me doesn't look like this big loser compared to the others. It actually still looks relatively strong. And so short term, dollar index is in a downtrend. I get it. Long term, though, pull out that monthly chart. And the question is this one big pullback? And maybe is, you know, US dominance? The question is, as we pull back, we see this longer term trend line breaking or potentially breaking. It depends how you draw it. This is the problem with trend lines, is you can different ways, right? We're sitting right there at it. So it's a question of where do you think we're going? Is US dollar dominance going to stay or not? Real quick, and I want to get your response too to this. If you guys want to try out the Edge Finder, we'll drop a link here in the chat to where you can apply for an Edge Finder trial. We also offer a free course on how to use the Edge Finder. Even if you never buy the Edge Finder, the course itself is tons of value. It can help you to understand how macro can impact charts that you care about. So we'll drop the link here in the description right here. Boom, get an Edge Finder trial and take advantage of that right there. Okay, Chris, what do you think? Dollar index, are you kind of thinking something similar, like dollar index? How much downside?
How many times do we hear that the U.S. is the cleanest dirty shirt in the laundry or something like that? That was said all last year, and I feel like that's kind of true today. I mean, I said earlier, it's like I do think that this is a really crazy window that the U.S. can be outperformed by the world, but it doesn't mean that the U.S. is declining. It doesn't mean the U.S. is suffering or struggling. I think if the U.S. doesn't want to be second, third, fourth. The U.S. wants to be number one. Right. You know, we say that we're number one. If we're going to spend $1.5 trillion on our military, we probably will be by force number one. But anyway, point is, I look at those currencies and it's hard for me to be like, oh, this economy is way better. I mean, there's going to be ebbs and flows, but I think that the crowd has also been buying into this very noisy narrative that the dollar is going to get weaker and the U.S. is going to fall off a cliff. And it's like, I mean, if the U.S. falls off a cliff, you have to remember the whole world's coming with us. We will take everyone with us. If we go down, the whole world's coming with us. We're all drinking the same Kool-Aid. We all have the same debt problems. It's like this financial market, this financial game is leveraged to the teeth. And we can't afford, the world cannot afford to really see anybody have a recession, let alone the US, let alone China, let alone Japan. It can't afford it. And, that has been kicked down the road since the great financial crisis.
Yep.
And we will continue to do so. And I again, like somehow, and maybe this is the wildest thing, but what if the US does something even more radical and they seize all the world's gold and then we pay off our national debt? Because we can. It's like, I'm telling you, man, like something wild is going to happen. And I'm not saying it's 2026, but right now, all the stuff you're showing there in Edgefinder, the US is still growing. I mean, the GDP prints are better than they've been in a long time. Like we might see 4.5 to 5% GDP. And even though we have a struggling labor market, it's fine. It's just growth. It's corporate growth.
Yeah. And the rest of the world is just not putting up that type of growth. At the end of the day, one thing that this is where I can't get just outright dollars going to crash too hard, because I think to myself, I'm like, the AI trade is here. Innovation is here. Companies come here, right?
Right.
That's the challenge of it is, it's like you said, it's the least dirty shirt in the laundry.
Yep.
I love that. I love that saying. That's pretty perfect. It's like, the US has massive national debt problems, but exactly what you just said there too. Who owns national debt? All of us, everyone, single one of us, everyone watching this stream right now. Did you know you own US national debt, whether you knew it or didn't like it, or you like it or not? Like, it's just all of us, because if it implodes, it will impact every single person on planet Earth that is part of the grid society whatsoever. So unless you want to live, I mean, hey, maybe you could go set up camp in the backwoods somewhere and live off the grid, and that's one option. But otherwise, the US dollar crashing it would be detrimental to everyone.
Yeah. And I think that, I just think there's more stability in it. Look, if it doesn't look like a clean trade, then don't take it. I mean, if you got a plan on the dollar and your plan is to short it, have a plan, have an exit. If it works out, you're right, great. If you're wrong, then go find another trade. I said last year, like watching currencies, if I'm looking at something big picture, the dollar basket or the yen basket is going to be probably the most active basket that I watch and has the most potential. Like the catalyst could be all over the place, right? Like a big move in the dollar basket, a big move in the yen basket, that's going to move, currencies would move hundreds and hundreds of pips across the board. So right now it's like the dollar's still kind of range bound. I know we had a big drop for the last 2 or 3 days, but it dropped right back to key support. And if that support holds, I think that it's a buy low, low risk, buy low opportunity, and see if the dollar sticks. And that was just like a bit of a head fake. But I think Trump and company want a weaker dollar. I think it benefits us. But I don't think we want to have like the dollar absolutely implode. I mean, what happens if we see like a Turkish lira type move on the dollar? Like, that's not good for anybody, So anyway, I just think that the narratives get really noisy, and the dollar is still like super liquid. Your dollar basket is pricing a lot of euro. I mean, there's always a mix of everything. But right, like I said, if I'm gonna look at the dollar right now, my cleanest trade is I like New Zealand dollar long. My Aussie dollar hit profits. Dollar yen is the only one that's moving with the yen, so I'm staying out of the yen basket right now. Did anybody get yen short, by the way? Did you get like dollar yen short? If you did, great trade. You had 650 pips to move, but I didn't trade it. I was trying to short it like 161, 162. We never got there. We stopped at like 157.
Right.
So anyway,
Chris, we've got I've got the press conference here loading. I do also have a stop at 3 p.m. I'm jumping.
That's fine. I've got another session at like 3:15, so that'd be perfect.
Okay. Yeah. So if you want to stick around, we'll just listen in, see what old JP has to say, and should be good. If you want to just mute yourself once this starts, in case I don't want you to hear yourself. I know the echo due to everything, but just going to turn this volume up, make sure we're good here. Okay. And what I'll do here is I'll put on our, let's do this. Let's just clean up this look a little bit. And we'll go, where's my all markets? There we go. Okay. Let me know if you guys can't hear them, but I think we should be good.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
That was really short.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously, and I guess in 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting. And that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No. And I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something there's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market and the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data implications and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course, no one knows with any precision. So, you got to follow up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate. That the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with. And that, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer term rates means less accommodative financial conditions. But remember, many things move longer term rates. It's not mostly what happens on the short end. There can be effects of longer term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy, democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Thanks. Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading.
All right, guys, I gotta shut off the stream. We're switching gears here to the live trading session. Chris, thank you very much, man, for coming on, for being a part. I know you got to run as well. We'll see you on the next one if you want to.
All right, I'll see you tomorrow morning.
Yeah, see you, man.
All right, bye.
Yeah, guys, so we're going to be switching gears here, heading over to our next stream event, which is happening right now. We're going to be doing a live trading session on the trading battle. If you'd like to join me there, here is how you can do that. So what you can see here is we just dropped the live stream link there in the chat. So click that link. You can join me there. Okay, yeah, hold on. Let me drop it one more time. Here it is. Join me over there. We're going to be live trading this post-Fed meeting. Trading starts now. So now that we've had some commentary from Powell, we got most of it out of there. We are now going to be starting a live trading session over on the trading battle. These are always a lot of fun. We're going to be placing a lot of trades on cryptos, gold, silver, US dollar pairs, Japanese yen pairs. We have a lot of stuff coming your way here, and the trading battle is starting right now. Join me over there, and we will see you. Me and two other contestants are going to be trading that post-Fed meeting live. So click the link. It's in the chat right now, and we'll see you over there.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.